So I think that, multi-baggers can come in number of shapes and sizes. The most obvious ones can be technology business, right? So now the issue with technology businesses is that, like Buffett says, industries with rapid change are the enemy of the investor. So we would need to find tech businesses which have kind of got attributes like, for example, a Microsoft, which has a very strong install base of cloud-based applications and such and software, which people cannot do without and people cannot change easily and such. And we would need to find those businesses at reasonable valuation. So usually the problem we get into with these great software companies is everyone knows they're great and the prices reflect the greatness. But sometimes you can get aberrations. You can get, like, one of the things that happens is that when a packaged software company is switching to the cloud, so the revenue is going from licenses being sold to a recurring subscription-based model, the revenue will take a dip initially because as they're transitioning, if Microsoft sold Microsoft Office as a package, they would collect like $500 or $400 one shot for one user. When they do it through a cloud-based offering, they get like, $8 or $10 a month. And so near term, your revenue will drop. But long term, you do a lot better because people may not, after 4 years, buy another package for you. They may run the same Word software for 10 years without upgrade, for example. So sometimes you can get a mispricing because the market doesn't appreciate this particular nuance of, the earnings taking a dip temporarily and such, and it's not being normalized earnings and so on. So you can get great compounders from the classic, very stable recurring revenue software businesses or cloud-based businesses and so on. That can be a valid way to go. You can also get it from companies that are really, really good at what they do. Like Costco in the United States would be an example. Walmart might be an example. So these are companies in really difficult spaces. Retail is a really, really difficult space to be in. But sometimes you get some businesses that are really great at it, and they've proven they can endure for a long time. Then it can work out very well. One other thing about these multi-bagger compounders, if we go back to the example of Rakesh Jhunjhunwala, is, like I said, he put 4% of his portfolio, which later became 50%. I think Titan compounded at more than 30% a year for a long time. And it has a great model. It'll keep going. I mean, I think that runway is really long. It tolerates a very high error rate because let's take an example that the other 96% of Rakesh's portfolio went to zero. If that had happened, he would still have a major home run. So if we make these compounder bets, and let's say we put 10% of portfolio into each bet, and we study these businesses carefully, and we make 10 of these bets like NVR, AutoZone, and whatever. The most important thing, which is the most difficult for investors, is after that, you need to go to sleep. So after making the bet, because nothing will go in a straight line, there will be news coming out all the time. There's invasions into Ukraine, and there's the inflation in the US, and the Fed is raising rates, and the business might take a hiccup here and there or whatever else. So there's 100 different reasons for which one might be tempted to take action. And to Rakesh's credit, considering that he had like 4 screens in front of him all day long, he never touched the Titan position for several decades, died with it. So the important thing in investing is not how smart you are. This is not a game of like the highest IQ person wins, because it's not that difficult to figure out if you gave me, or if I gave you a list of 100, the top 100 market cap companies in Thailand, and I just ask you to rank them in terms of quality of business, forget the valuation, forget everything, just quality of business. And I asked, 50 students to do that. Their list wouldn't be that different. What companies show up in the top 10 might be very similar. Top 20 might be very similar. Bottom 20% might be very similar, and so on. So the identification of a great business is not that difficult. What is the most difficult is not doing anything after you find yourself in the fortunate position of ownership of these businesses. So taking Rakesh's example, if you made 10 bets and you just said, okay, no matter what the news is, I'm just going to ignore everything. And in some cases, the news dictates that you should actually sell. The business has gone into secular decline, for example, and you can tell it's going. But let's say you take no action. You live with the secular declines, see some of them go to zero, all of that. It would still be an exceptional run at the end of 20 or 30 years. And the reason why most investors don't enjoy those great returns is because they get in their own way. They are not content with watching paint dry. If you are the kind of person where, some painter has painted some wall white color, and you can just sit there for 8 or 10 hours and watch it dry and be really happy, then this is the business for you. French mathematician Pascal, so one of his famous quotes is that all man's miseries stem from his inability to sit quietly in a room and do nothing. I would just paraphrase Pascal to say all investment manager miseries stem from their inability to sit quietly in a room and do nothing. And so one of the things I try to do is I try to do a lot of sessions with students like you because it absorbs the time. If I have too much time to, worry about the portfolio or think about things, it might cause action. Buffett plays about 10 or 15 hours a week of bridge. And I play about 10 or 15 hours a week of bridge. Bridge is almost as good an activity for me as investing. I think investing still gets a little bit of an edge for me, but bridge is a tremendous activity for me. I enjoy it a lot. If you put me in a prison cell for the rest of my life with 3 other bridge players and, the same food being served for every meal, I would be extremely happy for the rest of my life. That would be a very blissful existence. Bridge is a very healthy pursuit for investors. And so I think that investing is a great activity for gentlemen or ladies of leisure, gentlemen of leisure or ladies of leisure, where basically, if you can be really content to not take any actions on your portfolio, you will do really well. And one of the reasons the index is so hard to beat is the index is too dumb to know that it owns Microsoft. And it's too dumb to know that it owns Alphabet. And it's too dumb to know that it owns AutoZone. And it's too dumb to sell any of them. And so what happens with the index is that every once in a while, the people who run these indices make some change, right? Like they'll take GE out of the Dow Jones, take IBM out of the Dow Jones. Usually the changes they're making are made such a long time after these absolute loser companies have proven that they're losers. But they'll never take a Tesla or a Microsoft or an Alphabet, which is cranking and climbing out of the index. That will not happen, right? So they usually take out the companies where they see a decline in sales, losses for many years, the business has lost its way, and so on. And so that's the reason why the index is so hard to beat, because the index is really good at watching paint dry. It just cranks with doing nothing. And that's really what you want. And the only way to get better than the index, because the index also owns a lot of losers. But like we saw with the Rakesh Jhunjhunwala example, a 4% position becomes 50% because he just doesn't touch it. And so what ends up happening with the index is Apple starts off being really small and Apple becomes a really large position. And Microsoft starts off really small and it becomes a large position. And so when you look at the index after 20 or 30 years, you find like 7 or 8 companies that are like make up 30, 40% of the index and such. So that's why indexing is really good for almost all market participants. Most market participants will do better by focusing on the index.
Can you maybe talk a little bit about your approach to value investing? What do your principles, your process look like, and how does that help you find companies that you would own for decades?
So I'll have Ryan answer, and I'll tell you whether he's right or wrong.
Okay, all right.
So I'll start with our principles, which, if some of you know our firm, we literally have carved in stone just to make sure that we never forget them, which I think is a really helpful way to visualize it. And you kind of can memorize these principles. But I would say fundamentally, I think first and foremost, what we're looking for are really great businesses. And what I mean by that is ultimately, we're looking for businesses where we can have a very high degree of confidence what the future will look like out 5, 10 years. And a lot of those things, I think, ultimately come down to, if you want to call it a Porter's 5 forces analysis, but really understanding the competitive dynamics, the secular growth opportunities, and feeling that you can assess with a very high degree of confidence about how a business can end up. It'd be a lot better than we think, but really, in particular, this concept of margin of safety, making sure it can't be a lot worse than what we think. So we put a high degree of what we call business certainty. So I think, Bill likes to say it's kind of the simple, predictable, free cash flow generative business, which I think is a great line. But that's really the thought process behind what we're looking for.
Did he pass?
I'd give him an A-. And the only thing I would add is the following. A business, I would add to his 5, 10 years, 20, 50. Again, in the discounted cash flow analysis of business, years 5 through 10, 0 through 10 are worth a lot more than years 10 through 20. But what you're really looking for, business is like a bond where the coupons vary and there's no date by which the principal comes due. So it actually, it really matters what happens over time. And I think, to make it, I think one of the big things I learned from Buffett is that you sort through the world for things that you can understand and know. What's fascinating about the stock market is securities move up and down every day on the basis of all kinds of information. And I think there are many businesses, it's just unknowable what they're worth. But they still trade, they move up and down. It's kind of an interesting sort of phenomenon. What we do is we kind of screen for the world by the way, I would give them an A, just teasing. But I would screen the world for things that we can predict and know. And that has something to do with what we know, but it has a lot more to do with the characteristics of a business that have a high degree of predictability. And what we think about when we're buying businesses, these are bonds, really. We're looking for very, very high certainty, companies that we can theoretically sort of own forever. And that's the most difficult thing to do in investing, is not building a financial model, but predicting the durability, of a business, particularly in a world where there's constant technological innovation. When 2 students, who dropped out of, ABC, what used to be a great university, and rented a garage, and they come up with some disruptive technology, that's a very hard thing to envision. So you have to think about, think about moats. Michael Porter, who's another mentor of mine, at least, business school professor of mine, very sadly has severe Alzheimer's now. But the first book he wrote It's probably one of the most cited pieces of any kind of research, and so you should, give it a read. Just thinking about the various balances of power, if you will, in the forces that affect a business.
You maintain that the individual investor can beat the big guys, as you put it. How can that be?
Well, it's pretty interesting that from the research we did in the book. Most people know that the typical index funds, the S&P 500 and the Russell 1000, if you invest in those, they beat most managers, roughly about 70% of the managers. And that's pretty powerful. It's because of their low fees and that most managers aren't really adding value. So one logical thing to do would be to say, well, I know only 30% of the managers beat the typical index, so how do I find those guys? And it turns out if you look back over the last 3, 5, and 10 years of those managers' records, there's really no correlation between how they do in the next 3, 5, 10, which is really what you're trying to figure out. So that's why, most, many, at least advisors have recommended, and possibly rightly, that index funds for the individual investor who doesn't know how to pick stocks on their own is maybe a good opportunity for most people. So we set out to do something a little better. And as it turns out, the regular indexes, the S&P 500 or the Russell 1000, are seriously flawed, as it turns out. Even though they beat the most active managers, they're still very seriously flawed. And they do something that costs investors about 2% a year. And that really is that they're market cap weighted indexes, which means they put more weight into the larger market caps. And so that if a stock,
the losers.
Right. So if you believe like Ben Graham or Warren Buffett that the market's sometimes emotional, it's not efficient like so many professors have professed over many years. It's not efficient. That means that if the market does get emotional over the short term, that some stocks are overpriced and some are underpriced. And a market cap weighted index, if a stock is overpriced, it buys too much of it automatically. And if it's underpriced, it buys too little of it automatically because it's based on market cap, which is essentially price. So it sounds crazy, but it actually is systematically doing the wrong thing at every point whenever there's an inefficiently priced stock. And so there's an easy way to correct that. And there are actually equally weighted indexes. Instead of putting more in the larger market cap companies, it actually puts an equally weight. So if you have the S&P 500, it'll put as much weight in stock number 1 as it will in stock number 500. It still makes plenty of errors. In other words, it's an equally weighting, but those errors are now random, not systematic like a market cap weighted index. So you actually get back the 2% a year. And a few people have come out with something called fundamentally weighted indexes. It's just another way to weight stocks without using price. And therefore, the errors in those indexes are also random, and you get back the 2% from those too. And since we're value investors and have done a lot of research on value investing over a long period of time, we created an index that we call value weighted, which just means the cheaper something is, the more weight we put into it. And it's actually more diversified than, the S&P 500 or Russell 1000 index. Has the same volatility, has the same beta, yet over the last 20 years, you would earn 7% more a year following that strategy. And it's ridiculously simple. Just put more weight in the cheaper companies.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And it's conventional practice, and it may if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own one stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to have proper diversification? It'd be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love it, the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And the truth is, you don't need it. I mean, if you have a really wonderful business, is very well protected against the vicissitudes of the economy over time and the competition. I mean, we're talking about businesses that are resistant to effective competition, and 3 of those will be better than 100 average businesses, and they'll be safer, incidentally. I mean, there is less risk in owning 3 easy to identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that. But I can assure you that I would rather pick, if I had to bet the next 30 years on the fortunes of my family that would be dependent upon the income from a given group of businesses, I would rather pick 3 businesses from those we own than own a diversified group of 50. Charlie?
Yeah, what he's saying is that much of what is taught in modern corporate finance courses is twaddle.
Do you want to elaborate on that, Charlie?
You cannot believe this stuff. I mean, it's modern portfolio theory, and
it has no utility. But I mean, it will tell you how to do average. But I think anybody can figure out how to do average in 5th grade. I mean, it's just not that difficult, and it's elaborate, and there's lots of little Greek letters and all kinds of things to make you feel that you're in the big leagues. But there is no value added.
I have great difficulty with it because I am something of a student of dementia, and I have.
We hang around a lot together.
And I can ordinarily classify dementia, on some theory structure of models, but the modern portfolio theory, it involves a type of dementia I just can't even classify. No. Something very strange is going on.
Yeah. If you find 3 wonderful businesses in your life, you'll get very rich, and if you understand them, bad things aren't going to happen to those 3. I mean, that's the characteristic of it.
By the way, maybe that's the reason there's so much dementia. If you believe what Warren said, you could teach the whole course in about a week.
Yeah. Yeah, and the high priest wouldn't have any edge over the lay people, and that never sells well.
Right.